This is the week, folks, that Wall Street has been waiting for and agonizing over. This is the week when the Federal Reserve is expected to raise its benchmark interest rate for the first time in nearly a decade. Fed Chair Janet Yellen and her open market committee have laid the groundwork, signaled that barring some unforeseen change of heart, it is ready to raise. And one key thing many will be looking at is what effect will rising rates have on the housing market? Diana Olick explains.
Wendra Johnson hasn't found the perfect home yet, but she's going over her mortgage options now.
I definitely want to pay attention to what happens this week.
After years of record low interest rates, the possibility of rising rates has her speeding up her search.
We've been doing our research, but knowing that this interest rate is going to hit, we definitely want to stay in a tight window for making that selection. So I would say it is pushing us along to be very purposeful in our approach to buying a home.
Mortgage rates have been moving in a tight range, really since the spring of 2013. That's when the Federal Reserve first said it would ease out of its mortgage bailout, and mortgage rates then suddenly spiked. Unlike then, this Fed move has been expected for a while, so the reaction could be more muted.
So once they actually hike, it remains to be seen how much of that has already been priced in. But I think that most would agree that a majority of the damage that is going to be done by the Fed rate hike has already come to pass.
Mortgage rates don't directly follow the Federal Reserve rates. They follow bond yields. Put simply, it is actually possible rates could move down a little bit in the short term depending on how investors react. The consensus is, though, that over the next year they will move up, and both borrowers and lenders will face new challenges in getting mortgages done.
We can get a little bit more creative in our offerings and figure out other solutions as to how we can get home buyers to borrow just a little less than where the market is today.
It is likely we'll see more borrowers look to adjustable rate loans that carry lower interest rates but higher risk. More likely, given how conservative buyers are today, they may simply settle for buying less house. For Nightly Business Report, I'm Diana Olick in Washington.
Great.